But then what's additionally, just as if not probably more important, is the realm and the times at which you communicate out capital call. What does not go very well is when, oh shoot, my loan's maturing in 2 weeks, and so I need to raise equity in order to do X and Y. And if you don't give me money, then you're screwed as an investor and you're not going to get any of your money back. That doesn't work very well. But for people like, for example, somebody that reached out a year ahead of maturity and said, hey, what would it look like if you start communicating that 12 months, 9 months, 6 months ahead of time? Hey, this is what's going on in the market. Hey, this is what's going on in our submarket. This is what's happening with our deal. You know, we may run into this scenario, and it's not because we failed or didn't execute. It's just because of these conditions have changed. That's what's led to the more successful capital calls.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the real estate reality show at youtube.com/GowerCrowd. Thank you so much for joining me today. My guest today is Nate Trunfio, who is Chief Revenue Officer at Lima One Capital. Now, Nate was actually introduced to me through one of our clients, and I ended up being on his podcast and enjoyed being there very much indeed and learned a lot about what he was doing. In fact, that podcast turned into a bit of a Q&A where I was queuing him and he was A'ing my cues, actually. So rather than belaboring that on his podcast, he very kindly agreed to join me today to talk about what they do there at Lima One Capital. Now, what makes them interesting is that they're actually backed by a REIT, and they are a bridge lender. And Nate talks about the kinds of terms that they are offering. He describes or explains the trends that he's been seeing over the last 3 years and where he sees the market going over the next 18 months. Of course, today, and I do date stamp this in the podcast, but we are middle of October 2023. So if you're listening to it much after that, you'll know whether or not his predictions were right, of course. So Nate talks about the degree of distress that there is in the market today, where the distress is occurring and what kind of patterns they're seeing for the kinds of sponsors that are facing the hardest challenges to get out of this high interest rate environment. He is extremely knowledgeable and very kindly shares his knowledge with us. So you are going to be learning a lot in this episode. If you want a copy of my latest book, Capital Calls and Rescue Capital, it comes with over 6 hours of very advanced training on what I call syndication 2.0, which is the language of commercial real estate syndication during a downturn. It's very different. When there is a bull market, the language of a downturn is very different. And the training that you get with the book, Capital Calls and Rescue Capital, covers all the definitions that you could possibly want to know. It is required reading, required listening. And like I said, I guarantee you'll like it, or I'll give you $7 back. You can't go wrong. It's about the only real estate investment that is zero risk. So go ahead, splurge. You'll find it all there at GowerCrowd.com. Partway down the page, just click on the icon for the book, and you'll be able to get your copy that way. So without further ado, let's just move on to it. Nate Trunfio, Chief Revenue Officer at Lima One Capital, coming right up. Nate, it's good to see you again. Thanks so much for joining me. All right, so for context, let's start with what you do. You're there at Lima One, Chief Revenue Officer. What does Lima One Capital do, and what do you do for Lima One Capital?
Sure. Yeah, no, thank you, Adam, for having me on the show. Just excited to hopefully help share a bunch of knowledge here. So for context, Lima One Capital is a private lender operating in the business purpose lending space. We primarily service and provide financing solutions for all residential real estate investors. And so what I mean by that is we cover and provide products for fix and flip, single family new construction, single family rental loans on individual assets or larger portfolios. And then last but definitely not least is we have a big push in our multifamily bridge loan originations. And so I'm sure we'll spend a lot of time on that. My role here, outside of cleaning the closets and the floors as a super janitor, is helping drive originations and revenue. But a lot of what I look at, my role here is I'm fortunate to sit on a very illustrious executive team, and I'm the eyes and ears of not only our sales force, but of our customers. And so I spend a lot of time in different masterminds, making sure that I'm ahead of what's going on in the market and really sort of boots and ears on the ground, and then helping make sure that that gets passed all the way up through to the executive team as we look to, make projections forward and provide good products that, again, allow for investors to have solutions as well as a capital partnership in the money that we can provide.
All right, so you're a private lender, but you are associated with a REIT, aren't you? So what's that look like exactly?
Yeah, so we are very blessed to have been purchased in a fully owned subsidiary of a publicly traded mortgage REIT, which is MFA. Their stock ticker is literally MFA. They've been public and on the stock exchange. They just celebrated 25 years. So they have a ton of experience in managing risk and mortgage credits, and all things of the shapes and sizes. And then on Lima One, we're experts in the production side, originating loans, manufacturing loans, getting them from first application all the way to loan closing. And then another sort of unique element that we have here is that for essentially our entirety in history, we retain servicing rights. So we self-service all of our loans. And so we're not a shop that just sort of sells the paper to somebody else. MFA sees a lot of value in us creating relationships in managing the full life cycle of not only a loan, but of a client. And in the real estate investor world, as you know, relationships are key. So for us to be able to do it from, first intro and application all the way to when the loan pays off, it's an important value proposition that we're there with you through, thick and thin in all the phases.
So MFA is a REIT. So this is where I'm going to totally betray my ignorance, but that's part of what this call is about, to learn what it is that you do. So as a REIT, their assets are loans, are they? And so you keep all of these loans on balance sheet. Is that how it works?
Yeah, very much so. So a large component of their mortgage credit portfolio is in our space, private lending, BPL. And what's
BPL? Hang on, I got to cut you off. VPL?
Business purpose loans. And so, it's as our industry has really matured really in the last decade. We're an offshoot of hard money, which you can call us hard money if you want. We prefer private lending. If you want us to be hard money, we can charge more in rates and be there, but we don't do that. We're more institutionalized. And so, MFA also buys other mortgage assets. So they'll buy traditional residential mortgage. They'll buy non-QM, like assets for income for entrepreneurs. But we are their higher yielding product. And then also what's really cool, and we take a lot of pride in, is the fact that they used to buy loans from a number of different originators and loan sellers in our space. But we have proven to not only provide enough flow of volume in mortgage originations, but also proof of performance in our loan product, that they only buy our Lima One loans in their private lending, business purpose lending segment. So we are the only originator, single seller, as you call it, which is a good story for them and for us to say that we're proud of what we do, enough that it's all that they do in our sector of the mortgage industry.
So you originate loans and then you sell them into the REIT, do you? Or are they held under the Lima One umbrella?
Yeah, no, essentially they're passed through from balance sheet to balance sheet, from Lima Ones over to MFAs. As we've all dealt with different capital markets conditions, it's really boded well for us that Lima One has its own well-sustained balance sheet that we can hold loans on for X duration. And then it's sometimes a little longer than others if we need to, and then pass it over to MFA. And then MFA's main strategy of capitalization in our sector of their credit market is they balance sheet and then securitize all of our loans. And so that's sort of their model. They will still retain a piece of the securitization. And at the end of the day, all of the yield, gets passed through to stakeholders who own the stock as dividends.
Interesting. Okay, so they securitize the loans, so they don't hold them on the balance sheet.
Technically, I mean, you can securitize and not hold on balance sheet, but almost everybody it's no different than your multifamily capital stack, to where you're getting, first lien debt position. You typically will have LP investors, and then whether you co-GP it out with somebody else or you just hold a GP piece, that same GP piece is an element in securitization's capital stack. And so we, because of the liquidity and capital that we have at the MFA and Lima One level, typically hold a larger portion of the securitization capital stack and then sell off the bonds underneath it. Many people may only be able to hold, 2 to 5%. Depending on what the pricing is in capital markets and from bond buyers, we can hold the 5%, or at times we've even held up to 20, 25%. And that just shows, again, our access and prudence in making sure we have capital and liquidity to, be able to facilitate that.
So when you talked about, just to understand your business a little bit more, you talked about a great sales force and customers. So who is your sales force selling to, and who are your customers?
Yeah, no, love the question. So we have, and I won't get into all of this, but we have 6 different diversified sales channels that all have different approaches and different reasons for how they go to market. But when you boil that down, I'll distill it to 2 distinct functions and groups. You could call it, we have a retail sector of our business. And so all of those loan originators are creating direct relationships with borrowers and sponsors. In the mortgage world, you call it sort of direct to consumer or retail. And then the other element is sort of a broker, TPO, third-party originator, or wholesale channels. And that's facilitating originations through mortgage brokers and bankers who have the relationships with end borrowers. And so right now, we're about 60 to 70%, depending on the month, direct relationships with borrowers, and a growing amount that's intentional working with broker and banker partners, which provide a lot of scale for us as well. So that's who our sales force is working with. We're fortunate. We're just at about, including sales leadership, 90 total individuals in the sales org. And so we're proud of that, continuously growing and hiring. And then the customers, as I relayed, but specifically on the borrower part, we deal with a variety of shapes and sizes of customers. And so anybody who's doing their first rental property, their first fix and flip, to their first fix and flip of the day, and buying 20 plus properties a month. And same, multifamily is a little bit more experienced clientele. We do need to see some proof of execution and experience in having done or whether acquired or repositioned multifamily assets. But on the multifamily side, we're typically working with experienced sponsors, and many of them are brought to us by great banker relationships that we have through most of the investment sales shops.
Really? So so bankers bring you borrowers. Why do bankers bring you borrowers? Don't bankers want borrowers?
Yeah, but it's investment sales bankers, and so it's bankers from the way that we would call it from nomenclature. But at the end of the day, they're acting in a broker capacity, and more in the bridge lending space over the last 6 to 12 months. It's rough out there for many lenders, and so many lenders that used to either have balance sheet or some portion of a balance sheet and then a loan sale model have had to push that away because capital markets can be tough. We've stayed and hung in there strong. And so a lot of people that do have some balance sheet products still will look to pass borrowers on to us because our product is a better fit.
All right. So I'm going to come back to that in a second. But before I do, I wasn't able to tap it out on my screen quite fast enough, but I think you said fix and flip, single family rental. Yep. And multifamily rental. Wasn't there a fourth one?
Single family new construction. Yep.
Okay, so looking back over the last 3 years, so to the beginning of 2021, approximately, what proportion of your lending has been to multifamily borrowers?
Sure. Because we've been new in the multifamily space, it's continued to grow and eat our loan distribution share. And so we've gone from 10%, around 10% to about almost 25% right now.
And what does that mean in dollar terms over the last 3 years, approximately? If you can share that with me.
So what I can do is just to put it in perspective is last year we did around about 2.3 billion. That's 2022. Okay. We're on a similar run rate to do about that much in originations this year. You can follow MFA, our quarterly earnings. They very much specifically tout what products we solicit. but I'll let you sort of do a little bit of math. We were under 2 billion in 2021. And hopefully that points in that right direction of sort of the volume that we're doing now.
And multifamily is about, did you say 10% of that? 20%?
It's close to about 20-25, depending on the month, but 25% is where it's been lately.
So around 400 million a year for multifamily. Sound about right? And just for clarification, also,
and actually, I will just say, sorry to cut you off, Adam, but we did about 5 months ago just surpassed $1 billion in multifamily originations. So that gives you the historical perspective. And we've only been originating that product for about 4, maybe 5 years. Although, the beginning phases of it, we were really crawling out the gates.
That is exactly the number I was looking for. So $1 billion multifamily originations. Now, you are a bridge lender. Is that correct? Yes. Yep. So what kind of terms were you offering, or do you offer? Let's say over the last 3 years, what kind of terms have you been offering?
Sure.
To multifamily is my primary focus.
Yeah. So we pride ourselves being sort of in this private lending space on hopefully the goal is to provide speed, ease, and execution. And so we pride ourselves in being able to get up and down quickly. Our typical multifamily loan, if a sponsor isn't trying to just meet a close of escrow date and they're really trying to push hard, is usually within 30 days, which, is pretty darn fast, considering that we're consistently hitting that. And then again, we try to make the process as easy as possible. But to specifically answer your question, we're typically around, as the credit pendulum is swung. We've been historically 2-3 years ago around 80% loan to cost, 80% of acquisition and CapEx. We're now today more commonly at 75% loan to cost. And then we stayed pretty true to no more than 70% of the as complete or as stabilized value. And that's sort of where the leverage end of our product is set. As far as pricing, that's changed fairly dramatically over the last 18 months from the beginning of 2022. We are a fixed rate bridge product. So our product does not require you to buy caps or to manage any of that on your end. At closing, you'll know what the interest rate is for the duration of the term, which is typically 24 months. We can also extend out to 36 months. But pricing, again, is wildly moved as credit spreads have widened. And so we were, I'll give it to you this way. As a fixed rate product, we were around 6 to 7% in the heyday of the first half of 2022. Capital markets changed. Rates have changed historically as well. And right now we are pricing off of call it SOFR plus 450 to 500 range. And so, the interest rate terms, you're looking at round about, 10%, give or take, what the spreads are doing, 10.5%.
So you are relatively expensive money relative to other bridge lenders that were offering floating rate notes. How would you characterize the kinds of sponsors that chose to go with fixed term, higher rate loans versus extremely low rate variable rate loans?
Yeah, I mean, beauty's in the eye of the beholder, whether you want to call us, very different or not. And it depends on sort of what you're looking at. And so, we've actually, to put in perspective, is the first half of 2022. I mean, it was sort of free money to anybody and everybody, right? I mean, arguably the gap between what you could get sort of in the middle market of bridge, we were 150 basis points wide of, there's plenty of 4.5% effective note rate. And we were sitting around 6 to, again, 7. Today, though, bridge lending has really tightened up. And so the spread between sort of middle market and what we're offering isn't that wide when you're looking at leverage. And so to answer your specific question, I go back to, we come in for higher leverage loan opportunities. So somebody who's looking to invest less equity or raise less equity, somebody who needs to close quicker with, more surety of execution, whereas your banks, you don't know how many different approval letter levels and how long it may take you to get there. And then at the end of the day, we're also, more open-minded, I would say, to different deal strategies in different markets. Whereas a lot of your more core middle market lending, which, let's just for ease of terms, call it $7 million plus bridge loans. is very much more, primary, secondary market focused. If you're going outside of that, they're cutting leverage significantly and pushing pricing up. And so, again, there's a lot of variables to how commercial debt gets priced. And sponsors, again, look for us in the higher leverage, faster closing time frame, and surety of execution through a lot of times repeat business. I mean, where we've continued to drive a growth in our originations is just because we have our same clients coming back to us because they know we show up at closing with the same terms we told them we would from the beginning of the process, assuming all due diligence and appraisals come in where we expect. And so that's really where we fit in. So.
You say open-minded to deal strategies, and the one example you get was major and secondary markets. But what other kinds of deal strategies were you open, or are you open-minded to?
Sure.
Are not down the fairway, so to speak.
Yeah. I mean, I think just the different levels of reposition of an asset, and so especially nowadays where credit's a little bit tighter in the commercial world. We're more willing to read into what could be seen as a heavy lift business plan, whether that's just re-tenanting a whole property that's already highly occupied, or heavy lifts in true CapEx dollar size, and we're not afraid of doing that. And so that's some of the areas of it, and then others is just. I mean, Adam, like it's just there's so many idiosyncratic natures of different loan products and multifamily that we're just open-minded to a lot of it. And right now as well, this is the year in 2023 of historical all-time debt maturities in the commercial realm. Some and many bridge lenders are just, if you're looking for a refi or recap, just we're not going to do it. We're not at that standpoint. We take a conservative or realistic approach to underwriting, and we're trying to figure out, is it a failed business plan, or is it just the true elements of what we've all been dealing with, elongated the business plan. And so we have been finding our place in the right kinds of refis with the right risk profile. But again, there's also plenty of those that don't make the cut just because there's too much inherent risk that we'd be taking off of someone else's balance sheet and onto ours.
That's for new borrowers, right?
Correct.
What about for existing borrowers that you were lending to, 2 and 3 years ago, or at least over the last 3 years, who are coming to loan maturities? What are you seeing amongst them with cap rates where they are and values having collapsed essentially?
Yeah, it's
especially with an 80% loan to cost. I mean, you got cap rates.
Sure.
Even a 4 to 6 is a 30% loss of equity. So that's, are you seeing a lot of deals now that are worth less than the debt you put on them?
No, we're very fortunate to not be in that scenario where we're so-called underwater. Although it could come, as you sort of listen back to the trajectory of our production in multifamily, we've grown a lot. So what's coming to maturity now isn't as much as will be next year and the year following, just because of our growth in production. But from what we've seen, we've been very pleased with our multifamily loan performance, and that's why we're still originating pretty aggressively here today. But for the ones that may not have gone to business plan, we're seeing just a small delta in what they need to bring in, like cash in refis when it comes to getting permanent financing. But at the same time, as conditions have deteriorated. If you go back 24 months, at the end of the day, depending on market, you're still gaining some value in the, overall cap rate compression, as well as over that duration of time, the rent increases as well. And most of what we've done has always been true value add financing CapEx in order to reinvest that into assets or reposition assets. And so because we keep in-house servicing, we also keep a good pulse on sponsors as they go throughout their business plan and are able to stay ahead of it. So you're looking at scenarios of cash in refis on the ones that weren't able to fully execute their business plan, number one, or number two, people are just realizing they need to go to disposition rather than hold a property for, another hit a five-year total investment horizon and, dispose at that point. They're realizing, oh, shoot, let's get out now because, what's ahead is not pretty. I need to do capital calls with investors or bring equity in. Let's just, sell, dispose, return what equity we can or we do, and keep moving and waiting for the next best opportunity.
And so are you having conversations with sponsors about how to extend and accommodate change. So what kind of conversations do those look like?
Yeah, so what's been a little bit tough in those conversations is just like the cost for everybody else to finance a new loan today is higher. The cost for us to retain financing on loans that come to maturity is higher, and so we have to pass that along. And so that's when reality really starts to set in. Our servicing team does a great job in proactively reaching out, and a lot of our great sponsors and repeat ones specifically, they know the process and they're reaching out. I mean, we have people, heard the other day, somebody reaching out a year ahead of their maturity just to see what it would look like today so that they can amply plan what they may need to do as the tides have shifted and changed in the investment and in the market in general. And so, we're really just having conversations. And I think if you were to ask me what's the best advice I have for borrowers in those situations, it's just to communicate. The more that you try and hide things or push it under the rug and avoid communication with us, the more that we're just going to think that you're trying to pull something over on us or that things are worse than we see it. And then we're going to have to move to maybe more aggressive communication and tactics. None of that happens necessarily till we get to maturity point. But it's important, just like as you would probably advise, and as you did in our podcast, communication is key, and being proactive in it is just as important to your capital partner on the debt side as it is in equity.
So cash in refi, let's look at these two scenarios that you talked about. Cash in refis, what amount of cash typically as a percentage of the loan balance are you seeing is enough to, well, I don't know, what is the strategy? Are they just trying to survive to 25? By the way, this is October 23 for anyone listening. So are they just trying to survive to 25 and push it out long enough, or are they looking for we need to survive through whatever comes over however many years? That would be a factor of how they decide to do a cash in refi, presumably.
Yeah, I mean, so for our loan product in multifamily, we do 1-year extensions. So when they're analyzing their options, that's what they have to weigh and gauge. And yes, there's fees associated with that extension, many a times paid up front at time of at time of extension. In few scenarios, some scenarios we can look to defer it to pay off, but you're sort of just pushing the rock down the road. As far as to your question on, cash and equity in refis, I mean, it's been as much and as small as sort of disclosing costs, but is, to the tune of, and this is actually more secondhand, not from our book of business, but 10% of original cost basis. And, most of that has just become because of things being constrained on debt service coverage when it goes to permanent financing and with agencies. There's been some creative deal strategies. I mean, many people will have to do capital calls to their LP and investor base. The others have looked at, and again, this is all sort of secondhand information from many other loan originators out there pushing bridge and permanent financing products. Some of them are looking at mezz, and mezz isn't cheap, and also raising additional equity isn't either. And so that's just sort of where, to try to get behind the scenes of the psychology, it is really, well, how much do we need to raise? At what rate can we look to offer a return on that additional money raised, considering that we were hoping to have returned back some portion of capital, or in many scenarios, all the capital, a majority of it. And if I'm bringing equity in, I need to pay returns out. But wait, debt costs are higher. Expected equity returns are typically higher from those LP investors, whether institutional or mom and pop, just because there's more risk in the market. And so, it's a lot to analyze, but, I know that's where you can come in, Adam, and helping, give some of your consultation services as well.
Thank you so much. Right. So cash in refis, when you do a cash in refi, I'm just going to flesh this thing out. Yep. Sorry, not a cash in refi. When you do an extension, so you're giving somebody beginning of 22 a loan, and we're coming up to maturity, 2-year loan, and they say we want that 1-year extension. That 1-year extension is at the new rates. It's not a 1-year extension at prior rates. You're basically renegotiating the terms of the loan completely. Is that right?
Typically,
on an
yes.
extension. Not a maturity.
Yeah, there's to make it simple, typically, yes, it's a new market rate being passed along. There are variables and nuances depending on how the loan doc's read and things of that sort. And so there could be some instances to where the original note rate could be still retained. typically in that they have to have hit specific performance metrics and be under certain, LTVs or and things of that nature in order to sustain that. We wouldn't. The bottom line is that, like, if the risk profile has gotten worse, your perceived leverage on what our loan balance is to today's value is higher. Typically, that's not an available option. But for most people, it is having to absorb the new and current market rates. We do typically pass a small advantage on to extending customers, just because at the end of the day, we are not, what I like to call a loan to own shop. We're here with vested interest for our borrowers and sponsors to make it out with profits, hopefully, but at the least alive. So
what is the difference between if all the terms change on an extension? You took out a 2-year loan, it's coming to the end of that 2 years, and you get a call saying, all right, we want to extend, we've got a 1-year extension, and all the terms are actually renegotiated. How is that any different from a full maturity?
I mean, just to understand the question, I mean, it's technically it's an extension of the maturity. And so, maybe your question is, how is that different than just refinancing?
Yes, exactly. Because the terms are, I mean, you're going through a lot of work to do it anyway.
Sure.
Right. And you're redefining all the terms and you're reevaluating the deal. So is there any difference between somebody coming and say, listen, our 3 years is up.
Sure.
We need to replace this debt versus an extension? Is it actually a different conversation that you're having with them?
I mean, what I would say is, I know to borrowers who have to go through, maturity/extension, it seems like it's all the terms, but technically it's really just the interest rate. And then there's a already disclosed fee when the loans originated on what would need to be paid at the time of an extension that's based on lender's approval. The reality becomes, how much time does somebody really need? And so if somebody needs another 2 years on their business plan, yet we're only offering a 1-year extension, then they're going to lean more towards, okay, let me look at refinance. But typically, when it comes to extension, we're just doing an internal analysis on, where they're at plotted along the business plan and what we think the value currently is. We're many a times not getting a full appraisal. We can and will if we need to. But, the typical risk that somebody has to weigh is, all right, I have surety of getting this extension and getting another year so that I can navigate the rest of my business plan to point, B or C at that point. Whereas if I go for refinance, I got to truly start over, get full appraisals, and it may be a worse scenario, where most of the time, although there's some caveats, not asking for equity in, but if you go a refinance route and things don't pencil out for an appraisal value, you may have to bring equity in. And so a lot of the decision will come down to what somebody perceives the value is compared to what, it started out as and what our loan balance is. And so if they think they've really done well with the business plan and cap rates haven't, widened out too much in their market, they very well may, benefit from a refinance. But again, right now in the loan origination world, getting a bridge loan on a bridge loan is really tough. And then getting permanent financing, depending on where you're going for that and locking in with, defeasance or yield spread or what have you, you're locking in at a time when rates are high, and you're going to, truly lock yourself into those rates, and who knows what happens as they may float down or whatever they may do. So
I see. And so what proportion of borrowers are going to disposition? They realize that the extension's not going to work. They can't refi for whatever reason.
It's a tough one to answer. I don't have that offhand. There's plenty of good reasons for people moving to disposition, right? Because they truly create a value, or, they caught the tailwinds of the market still, even though it's been headwinds lately. I think people look at selling the asset probably as a last resort. And what they'll typically do is, work with us. We give them an easy extension option, sort of black and white. Here's what it is. It's pretty low maintenance and brain damage for them to go through that. And then they spend their time shopping with a mortgage broker or banker to see if they can get a refinance. And then it comes down to the wire and we're like, hey, if your loan matures, technically it moves to technical default. And we don't want to go to that. And so that's really where the rubber meets the road. And at that point, though, if people have delayed too long going through a disposition process, they're still going to need to extend their loan unless they want to go truly into default. But that comes with its own, penalties of default interest, which is very high, much higher than market rates. And so that's where I would say less people are disposing of assets because they're trying to figure out if the extension makes sense or if there's other debt options. And at the end of the day, none of those options are necessarily great or what they originally expected. But they're, working through figuring it out, and many of them still have to buy time even to properly dispose and to properly market and go through due diligence through acquisition process.
All right, I'm going to come back to this in a moment as we wrap up and talk about trends over the last few years and where you think we're going. But let me bung this question in. You mentioned that some sponsors are going for capital calls. They're doing capital calls. So in your experience, what, to the extent that you see actually inside these capital calls, what makes a capital call successful? What kind of sponsor raises the most money from a capital call from their existing LPs?
Yeah, I mean, I have a lot of prior years experience sort of on the equity, whether it's as a pref or secondhand through GP. And so I'm going to relate more to that than the recent time frame. But, it's a number of things. And the main ones that come to mind is continued proof of execution. And so as you lay out a business plan from day one, we may be far down the road now to where someone may need a capital call, but if you hit your other milestones along the way and showed that proof of execution, whether it's on a singular asset and deal or it's on numerous other assets that you've acquired and owned and maybe even sold, seeing that proof of execution has really allowed people to have faith that, hey, you have a plan. And yes, the winds and the environment has changed, but you've always had a plan and have executed. That's probably, number one. But then what's additionally, just as if not probably more important, is the realm and the times at which you communicate out capital call. What does not go very well is when, oh, shoot, my loan's maturing in 2 weeks, and so I need to raise equity in order to do X and Y. And if you don't give me money, then you're screwed as an investor and you're not going to get any of your money back. That doesn't work very well. But for people like, for example, somebody that reached out a year ahead of maturity and said, hey, what would it look like if you start communicating that 12 months, 9 months, 6 months ahead of time? Hey, this is what's going on in the market. Hey, this is what's going on in our submarket. This is what's happening with our deal. We may run into this scenario, and it's not because we failed or didn't execute. It's just because of these conditions have changed. That's what's led to the more successful capital calls. Again, albeit I haven't seen a ton firsthand under the hood. But from all that I hear and know and what we see on the loan side is I get more visibility to how capital calls are going with people that want us to, refinance existing debt and take on another bridge loan or a new bridge loan. That's more of what we see, and sort of we dig into a little bit of how are you raising equity and what's been related to investors or not.
Do you find that sponsors who are more communicative with you are more communicative with their LPs? Do you think there's a relationship between that?
Typically, yes. Typically, yes. And I think that just boils down to, the personality profile and how people operate. Typically, you need to be communicative with both sides, because what your debt provider will do will affect what you need on the equity side, whether that's returning capital, which is the hopeful scenario, or having to raise more capital. And so you need to be communicative with both. What we'd see is the, sort of black box, no communication with your lender or your equity provider. And we haven't seen much of this, but I would imagine coming forward here soon, we as a lender will be getting a lot more calls from LP investors on, hey, I can't get my sponsor. And that'll be, continued red flags for us, although hopefully we've stayed ahead of that.
You get calls like that, do you?
I can't say firsthand we have. I would just say I wouldn't be surprised if, as we move forward, we get some of that.
All right. Gosh, what a fascinating, Nate, I mean, I could talk to you for hours actually, but I am going to pull it short because I like to keep these podcasts down to average commute length, which is 30 minutes, apparently across the country. Of course, I like to make the joke in LA, it's about 3 hours.
Yep.
But 30 minutes. So what trends have you seen over the last 3 years, and where do you think we're headed in multifamily, let's say, through the end of 23 and through the end of 24?
Sure. Yeah, I mean, the broad trends is, you have to actually know what you're doing and operate and execute assets. And, there's a lot of realms of asset management whether you're looking at construction management, if that's relevant for your deal, or property management, if you're doing it firsthand, or, as many have learned, especially recently, you actually have to manage your third property management. And so, that's the big trend, is those who are just sort of floating by, rising tides raise all ships, are really getting called to the carpet right now and are trying to figure out what to do. That's very much more investor focused in what we're seeing and what I've seen in that level. Yes, cap rates are widening, rents have flatlined, interest rates have gone up. All those convect at the point that we're at in the market right now. I think what's been really interesting is the differentiations of opinions from buyers and sellers. That's led to very low multifamily transactions throughout this year. We see it as it's less acquisition requests, but if you look at NMHC type data or anywhere else, transactions have just really gone downhill significantly. And so as we look forward, I think that gap between sellers and buyers' opinions of value has already shrunk. I think it's going to shrink fairly quickly, as sellers are going to need a further impetus to sell. And I think that will start to lean back towards more healthy levels of transactions, although I think it's going to take a little while for us to get there, just knowing where debt's at. I think what keeps all of this market propped up is how much money there is still sitting on the sidelines, whether it's in active acquisitions or there's still billions and probably trillions of dollars of distressed debt equity that's just sitting out there waiting. And so all of that money that's, wants to take advantage of all the value that investing in commercial real estate and specifically multifamily has, is just going to keep this so that there's not a great financial crisis, in the market. So I think overall it's going to slow down. It already has. It will still be slow for a while, but it's going to ramp back up. Rentership, us being a rentership nation is not going to go away. We can't create a ton of housing supplies. Our new construction product is performing so well because people can sell new construction very easily because it's the only way to really create new housing. And there's just not enough of it to keep up. So by definition, people won't be able to afford buying. And if they need to move, they're going to choose to rent versus buying in a high interest rate environment. And that's just going to bode well for multifamily fundamentally. I think you're just going to be back to the normal, 2 or 3% income and expense growth, because you can't inflate it and only show income growth with no expense growth, hence inflation. So we're just getting back to what's probably more normal levels, over the last number of years of multifamily investing.
Well, it's interesting you say that. This term normal, getting back to normal, it's an interesting idea. What is normal? Well, normal to me anyway is when you can underwrite according to today's assumptions, right? Interest rate, taxes, insurance rates, capex costs, rent increases. When you can underwrite a deal that is on the market and it makes sense, that's a normal deal. But anything else that's what's freezing everything up, isn't it? Do you think we're going to see more distress though as this wave of maturities comes through in 2024? Distress meaning folk that can't refi, you won't give them an extension, and the value of the property is below what they owe, so they're really struggling. They can't even sell.
Without a doubt. It's already happening. And I think if you look, let's all hope and pray it's not going to get nearly as bad as what's going on in sort of the office sector. But if you look at all of the data and delinquencies on that end, it's going to happen, just it'll be a lot shallower level, just because of the fundamentals of, supply and demand and rents, and what residential housing is needed. And so it will come. But that'll create new opportunities for buyers. And like I said, there's still plenty of debt available. We still have plenty of competitors that are out here pushing loans just like we are. And there's still plenty of equity, smart equity that's going to stay in the game and look for opportunities as well.
Nate Trunfio, Chief Revenue Officer at Lima One Capital. What a pleasure. Thanks so much for joining me on the podcast today. Well, that was Nate Trunfio, Chief Revenue Officer at Lima One Capital. Nate, thank you so much for joining me. It was a real pleasure to have you on. Thanks for having me on your podcast as well. I look forward to staying in touch. And thank you also, dear viewers, for joining us today. If you want a copy of my latest book, Capital Calls and Rescue Capital. It comes with over 6 hours of very advanced training on what I call syndication 2.0, which is the language of commercial real estate syndication during a downturn. It's very different. When there is a bull market, the language of a downturn is very different. And the training that you get with the book Capital Calls and Rescue Capital covers all the definitions that you could possibly want to know. It is required reading, required listening. And like I said, I guarantee you'll like it, or I'll give you $7 back. You can't go wrong. It's about the only real estate investment that is zero risk. So go ahead, splurge. You'll find it all there at gowercrowd.com. Partway down the page, just click on the icon for the book, and you'll be able to get your copy that way. Again, everybody, thank you so much for joining me today and for listening to Nate Trunfio from Lima One Capital. Again, Nate, thanks for joining me. And until next time, this is Adam Gower signing off.